Kenya is among the African countries expected to exhibit rapid GDP growth, this despite operating in a tough economic environment. In the month of September, the country experienced a marginal growth in its inflation numbers to 5.97%. I spoke to Ashif Kassam, the executive chairman of RSM Auditing, on what are the real threats to the country's economic health. Kenya, leading economy in East Africa, but we're operating in a very volatile economic space in the wake of all that is happening globally. Help us, I just put in context in terms of where we are now.
I think we cannot look at Kenya without looking at the global economy. I think global economy, the US itself has really strengthened, and that's why the US dollar has strengthened against all the currencies. On average, the US dollar has gone up by 20% against all the big currencies. So that's the worry. China's slowdown is another worry. Okay? So if we place Kenya in the global context, where are we? We've seen our shilling depreciate against the US currency by 17%. Now, this is one thing that people are not talking in the market. People are saying we are depreciating, but are we depreciating like others are? Or, are we depreciating more than others are? So the first issue is that Kenya's currency has depreciated less than what other currencies have depreciated, even in East Africa. And so in Kenya, while we are holding on to the 17% and saying that's fine, we are losing our regional competitiveness, and that's also hurting our growth in our economy. So I think that's the bigger problem that we are facing at the moment. The second problem that Kenya is facing is that we have never had a proper export strategy. When we opened our economies to liberalization, we never took exports seriously. And this is now coming to haunt us. Our export to import ratio is below 30%. I'm told this year it's even gone down to as much as it's about 20%. So that means we are importing 5 times what we are exporting. And that's the other reason that is putting a real pressure on the Kenya shilling. Okay? And technically, if that pressure is really taken in, Kenya shilling should have depreciated much more than the 20%. So the fact that it's only depreciated at 17% means that this is a very resilient economy.
Are there real interventions that can come either from the central bank or from Treasury to ensure that price stability is best maintained? Because as it is now, there's short-term, mopping up of liquidity that happens. But if we were to be in this space competitively, as you put it, are there interventions that can be done?
So first, let's understand the economy where it is. Yes, there is a monetary policy and the interest rate increase to squeeze the liquidity in the market. I think that was required to maintain the exchange rate, and yet short term, this is not good. Because one is that you're drawing liquidity out of the market and placing it in government bonds. The thinking behind it is we'll attract foreign exchange, which will help us manage the exchange rates. How that will pan out really needs to be seen, because there's a global liquidity crunch everywhere. But on the other hand, we are not totally reliant on our bonds. Only 5% of our bonds are held by foreigners. Okay? So to me, that is the thing, that while we are increasing the interest rate in the hope of attracting more money in, historically, that's not been the case. So what we are doing is, by increasing the interest rate, we're just making the cost of borrowing more expensive. So short term, we are doing things that are going to be difficult. But if you look at Kenya in the long term, what are the positives? Number one, most of our debt, especially the treasury bill, treasury bond, are owned domestically. Number two, we are still growing at 5% plus, whatever figure you put it at, 5, 5.5, 6, they're different figures, but it's about 5, okay, which is not bad. Last quarter, we also grew by 1.7%. This was against the expectation. If you look at our foreign exchange reserves, we are at nearly four months, import cover. If you look at the IMF review that was done in September, IMF have clearly come out in the report to say that Kenya is a very stable economy in terms of borrowing, and that its debt levels are sustainable even if the economy were to grow only at 2 to 3%. So these are real positives for the long term. In the short term, obviously, we will see a credit crunch. Number two, we will see the property market, which is, really buoyant at the moment, slowing down. Already indications are that property prices can be negotiated 20 to 30% down.
Right.
And that trend is being seen.
You alluded to the numbers we saw recently from the Bureau of Statistics that indicated we've grown 5.5%, which is below the expectation of 6%. And obviously the concern has been, are there measures that can improve our growth? We've seen a lot of big ticket infrastructure investment in this region. Is this the silver bullet to hitting 6 or even 7%?
You have to look at the growth on two parts. Yes, one sector will grow, that is infrastructure. Mm-hmm. But the second part that we are not looking at is our exports are going down. Mm-hmm. And they're going down significantly, even to the region. Okay. I remember the CS saying that he had seen a figure of about 19% export to import, which was very scary. So, that's where the problem is, that when you grow, all sectors need to grow. If only one sector grows and the others are not growing, then we have a problem. We all know that we are expecting El Nino. Okay? Heavy quote strategies how to mitigate the risk from El Nino. So yes, agriculture has grown, and one of the reasons we have grown to 5.5% is the good agricultural growth. But what if there is El Nino and all our crops are spoiled? Do we have a strategy around that? So I think some of the long-term areas, we have not given it enough weight in terms of having a strategy. The short-term strategy is good to mitigate the short-term problems. I think we need a much bigger focus on the long-term strategy, which is mitigating our weather risk, increasing our export strategy. And I keep on coming to this because we don't have one. Right. Third is really our fiscal indiscipline. Okay? And fourth is our ballooning recurrent expenditure, compared to global benchmarks. Right. And if there is no proper focus on this in the next 6 or 12 months, the short-term resilience that we have, will not be sustained beyond that.